So stocks are absolutely crashing right now. S&P 500 is down, NASDAQ is down. Pretty much everything is a bloodbath right now. That's why I have on my red t-shirt today. So I'm going to show you an interview right now with Tom Lee. He talks about what he sees going forward for the stock market for 2025. And then after the interview, I'm going to give you my full breakdown on what I am personally doing with my $2 million portfolio, what I'm going to do for 2025 to capitalize on upside, or if we get a massive market crash, what am I going to do? So stay all the way to the end. This video is really going to help you guys out a lot if you're on the fence of, do I buy more? Do I sell more? What is the market going to do going forward? So here's the interview with Tom.
Significant declines now, especially after what happened last week on Friday. Tom Lee's here, Fundstrat Global Advisors, Chief Investment Officer and a CNBC contributor. This is not this is a Grinch rally or the Grinch sell-off. This is not a Santa Claus rally. It's not going as planned, Tom.
It's not. I think investors have been a bit nervous since December 18th, the FOMC rate decision, and worried that the Fed may not be as dovish as investors previously thought. But I think fundamentals have remained intact. So to us, I think this is a bit disappointing, but it's, I think, a bit of profit taking, some hesitancy around the Fed. But I think it doesn't really change that 2025 is shaping up to have a lot of tailwinds.
So this just delays some of the continuation in a secular bull market that you've been talking about?
That's right. I mean, I think one of the lessons of 2024 has been we've seen periods of market wobbling and weakness. We know investors get pretty quick to turn bearish when that happens, but it turns out that these have all proven to be buying opportunities. I don't think there's a lot of signal to me that December's been a weak month. It is obviously disappointing because it should be a seasonally strong period, but if we end down even S&P 5,900 into year end, I don't think it just changes that in 2025. There's a lot to look forward to.
So what you thought might happen this year being put off. So what does that mean for next year? Let's say the first half of next year. What do you think we're in for? And with valuations and where multiples are right now, with all that in mind, do you think it could be a really positive first half of the year?
I do think that one of the things that we're watching most closely is what happens to CEO confidence early next year. We know they've been cautious for the last 2.5 years. It's really evident in looking at measures like the ISM manufacturing that's been below 50 since October 2022. And that's highly correlated with S&P earnings growth. I do think that that's going to finally recover to above 50, kind of signaling that we're back into an expansionary CEO mindset. It is purchasing managers. On top of that, we have an incoming administration that ultimately is going to be viewed by markets as pro-business, and I think that reignites animal spirits. And I think the Fed is going to prove to be dovish. Even if they're trying to figure out where neutral is, they're still supportive of markets. It's a good combination for I think, upside for equity. So, in the first half of next year, I think S&P can get close to 7,000, and that's a lot of upside from here.
7,000. You've made some prescient calls about inflation or about the markets based on inflation. Do you think recent worries that it's reheating are misplaced right now?
I do think inflation worries are misplaced. I know there's a lot of folks calling for a resurgence of inflation, and I know for whatever reason, January typically doesn't seem to be seasonally adjusted away, so we could see what looks like a surge in January CPI. But to me, the drivers of inflation are wages, and the Fed has said the labor market is not in a place that is inflationary. It's shelter, and we know shelter is really just catching up from the gap between where market prices are, which is not as inflationary, to how the statistical adjustments get CPI to where that needs to be. And we know auto insurance has really distorted CPI to the upside for the last few years, and that's cooling. So unless there is a supply shock coming, I don't know exactly why we would have a second wave of inflation. So to me, I think there's downside risk to inflation in 2025.
So there's a lot of problems with what Tom Lee just said right there. Tom is saying that the S&P could go up by quite a bit in the first half of 2025. But here's the issue. There's a lot of things going on in the stock market right now, such as valuations, there's tariffs. Everything's pretty much been pumping straight up for the last year, that maybe things are going to take a breather right now. So what is going to happen with the market going forward? Inflation risks are coming back, interest rates are going up, there's a lot of craziness going on. So let's break down the full shebang right here, and then we're going to go through my portfolio of everything that I'm going to do in my $2 million portfolio of how I'm going to capitalize on this stuff. So here's a heat map from today. I'm recording this video on New Year's Eve of 2024. Market's down overall. I've been saying for the last month or two in my Discord and on my Alpha Reports, these are the Alpha Reports right here, 100% free by the way if you want to get it, links below. But I've been saying for the last month or two, the market's overvalued and I feel like we need to take a dip. The market is now taking a dip, and that's 100% normal and healthy. You can see right here some of the biggest winners and losers. Check this out right here. Remember MicroStrategy just a few weeks ago was almost at $500 per share. There's so many people that are getting wiped out on MicroStrategy and Tesla too. I've been telling you guys, Tesla is expensive. It hit $475 like a week or two ago. Now it's down to $402. Definitely taking a hit, but everyone needs to chill out. So I have a tweet right here that I want to show you real quick. The market peaked out December 16th around $538 a share. Currently $515, it's actually below $515 right now. So we're down roughly 5% if you factor in what it did today. Even after that, we still did roughly a 28% gain for the year on NASDAQ. That is very, very good. The typical return that most people expect, and what I expect and what history shows, is a 10% return per year in the stock market. So when you get a year that's 28% or somewhere near that, it's okay to give a little bit back. So that's why next year I'm actually a little bit bearish, and I think that the market is possibly going to take a dip lower. But that is totally fine. I'm going to show you exactly how I'm going to capitalize on this dip, because when the market took a dip in 2022, I made millions. So if that happens again next year, I will probably make millions too. I'm going to talk to you about what I'm going to do on that in just a second. Fear Greed Index, super quick. We're at 28. We are in the fear category right now. I like to buy when we're in the fear categories over here, because that typically implies that the market took a dip. I like to buy on sale. All right, so going through 2024, we got to figure out where we came from to know where we're going. So 2024, we had a massive stock market run. S&P went up 23%, 57 record closes. It's the best 2-year return for the S&P 500 since 1997 and 1998. So roughly 23 years, 24 years, almost 25 years, we haven't seen returns like this in that long. So looking at this chart right here, it's actually a pretty cool chart. It shows you on the bottom the percent return of the S&P 500 and what years that the return was in that category. So you can see right here, most of the returns are in the green category, and that's typically what happens in the stock market. Usually the stock market goes up, but the stock market will go down some years. It will correct lower. Sometimes valuations will get stretched. I disagree with what Tom Lee said, that we're going to have another massive rally next year. I think that the market's going to be flat to up roughly 5 to 10%. Even Dan Ives, who's the guy on Wall Street that dresses all crazy, he was saying that the S&P and the NASDAQ are going to do another 25% next year. I don't believe in that. I don't think it's going to do that. But if it does, guess what? I'm going to win, and I'm going to capitalize on the upside. I'm going to show you what I'm going to do in just a second. But just a little bit more to reiterate on what happened in 24 to know where we're going to 25. So the NASDAQ pumped 25% like we already talked about. A lot of this was because of the Mag 7 stocks. They're absolutely printing money. Their earnings are going up like crazy. Here's a chart right here of NVIDIA's earnings going up like crazy. And Tesla. So Tesla's an interesting one. The earnings aren't really going up that much, but the stock did an absolute moon. The stock went from 190 all the way to almost 480. So it did a crazy move, and that move coincided with when Trump got elected. So Trump and Elon, like I said right here, they're pretty much best buddies. I said they're in a bromance. It's kind of funny, but Elon is smart. Elon is injecting himself into the Trump administration, and I feel like Elon is playing chess, and maybe Trump is playing checkers, and Elon is doing whatever he can to put his companies in a position to capitalize on the next 4 years of the Trump administration. So I said for Tesla, it's expensive right now. I've been saying that for a while now. Even though it fell from 479 to 403, I still think it's expensive. So I am selling cover calls on Tesla right now. I have 500 shares in the Schwab account. I'm making $1,200 a week. selling covered calls. So nice little income rate there on Tesla. Overall, I generate like 30K a month selling options, but Tesla's just the one where I feel like it's lofty, so I'm selling covered calls on it. But with Tesla though, if you like the company, you shouldn't buy the stock unless you plan to hold it for at least 5 years because the valuation is stretched. I feel like a lot of the future earnings of the company are being brought back to the current price right now. That's why it's 403 right now. Usually the market's forward looking by like 1 year, but Tesla's looking for like 4 years and bringing those earnings back. So be careful on Tesla. It could go down a lot more. Now, with regards to the Federal Reserve, they cut interest rates by 1% this year so far. So they did a 1% cut, but what's funny is that they cut 1%, so interest rates should go down, but interest rates actually went up by 1%. So they should have went down by 1%, they went up by 1%. So why the disconnect? And this right here is a fear and an issue for the market going into 2025. Interest rates are like gravity on the stock market. You guys know I've said this 100 times, and this chart right here, by the way, it's just showing you the interest rate hikes that we did right here, and then a few cuts that we had right here. So we were at 5.5%, now we're at 4.5%. So we did get that 1% cut total, but here's the issue. The stock market and the bond market is not convinced that interest rates are going to continue to fall going into the future. And the main reason why is because inflation is kind of sticky around like the 2.5% level. But this is what I tell people. We came down from 9% to 2.5% on inflation, and the inflation target is 2%. So we're literally like a half a point away from being at the Fed's target. So obviously we made really good progress on inflation. Now the issue is that people think that with Trump coming into office, maybe the economy is going to boom, which of course is a good thing. We want the economy to do good, but that could be inflationary, which means the Fed is going to have to keep rates higher for longer. So it's kind of like a double-edged sword. Do you want to have a strong economy with slightly higher interest rates, or do you want to have a weak economy with low interest rates? I've said it time and time again. I want to have a strong economy with slightly high interest rates, because why would you not want to have a strong economy? I mean, the whole name of the game is you want these companies to grow going in the future so they could grow revenue, grow profits, and that eventually leads to the share price going up. But if we're in a recession, these companies are going to have less revenue and less earnings, so the stock price is going to go down. So I don't care if your interest rates go down to 0%, the stock market is probably going to follow what the earnings of these companies do. So keep that in mind. Rates are gravity on the stock market. That is big. But here's the thing I want to talk about, and this is really what's going to lead us into 2025 and then what I'm going to do. I'm going to wrap this all up in like 3 minutes for you guys. I'm not going to ramble much longer, but all the info in this video is very, very key, and we're going to get into the key moment in just a second, so don't leave yet. Valuation concerns are huge. The stock market right now, this is the S&P 500 PE ratio since 1880. So the PE ratio right now is 30, and the PE ratio, price earnings ratio, is one of the easiest ways to get a broad-based valuation level on a stock or an index. So being at 30, just look at history. There's only been 1, 2, 3, maybe 4 times in history that the PE ratio of the S&P 500 has been above 30. So put that in the back of your head. Now here's the issue with that though. This is on a trailing basis. So you can see we're high right here on a trailing basis, but looking forward, we are expecting massive earnings growth. And if stocks happen to stay flat going forward, but the earnings go up, this PE ratio will go down and it'll go cheaper. So understand that, yeah, we're expensive on a trailing basis, but going forward, if these companies really start to earn a lot more money, this valuation is probably going to be justified. But here's the deal for 2025. The market has extremely high expectations priced in. The market is pretty much counting its eggs before they hatch, but I don't like to count my eggs before they hatch because here's the issue. If you say you got 12 eggs coming, but you only get 3, that's really missing expectations. But if you get all 12, then you're going to be happy. So I don't like to price in the best case scenario. I like to price in the scenario that is still a most likely scenario, but I want to have a little bit more margin of safety beyond that. So I'm expecting the stock market to go minus 20%, yes, negative 20% for 2025, but it could also go up 10%. So somewhere in that range between minus 20% to positive 10%, I feel like we're going to fall somewhere in that range with high certainty. We just had an amazing rally. Don't forget about where we came from. The last 2 years, we made a crap ton of money. I made millions of dollars in the market the last 2 years, and that was a lot because of how I positioned myself in 2022. So what am I doing with my portfolio right now? Well, I've been saying it for months. I feel like we're a little bit expensive. Now the stock market is starting to take a dip. So I want to have a lot of buying power on the sidelines ready to go if we get a dip. But if we don't get a dip, I'm still super exposed to the stock market so that I'm going to capitalize on that upside. But if we do get a dip, I'm going to deploy that buying power to either buy calls, sell puts, acquire companies, acquire shares of companies, whatever it may be. I like to buy when things are on sale. So whether we go down or we go up, I am prepared for both situations. And if you are an investor in a stock market, I promise you, you will be wiped out if all you think the market's going to do is go green. So if you want to learn more about how I do this stuff, how I made $2 million in the stock market, how I continue to generate over $30,000 a month with selling options and trading options, click the link below for my course. It's 60% off right now. It's not going to last forever.